Welcome back to the Real Estate Reserve Podcast. Jason Bellin from Hard Money Bankers, co-host Ian Horowitz from Equity Warehouse. If this is your first time tuning in, welcome. I promise we're going to have a lot of fun together. You probably learned something too as well. I'm looking forward to this guest who we're going to introduce in a little bit. He definitely has a long background of multifamily investing with, over the last 25 years. So if multifamily investing is something that interests you or you're currently a multifamily investor, definitely want to stay tuned here for the next 20, 30 minutes. If you're a return viewer, follower, listener, thanks again for all your support. Couldn't do it without you. Ian and I try to bring on kind of the best guests that we can week by week, not gurus, real estate investors that are on the front lines, actively operating and managing real estate. So looking forward to this one, Ian.
Yeah, if you guys get any value out of this, it's not about the likes or subscribes. It's about the shares. It's the best compliment we can give our guests. So if you get any value out of this, please feel free to share. And there's a lot of stuff going out on the world. I'm not going to waste your time boring you with what I think of what's going on and everything else. And let's use our time wisely and bring in Ken G from KRI Partners. What's going on, brother? How you doing?
Hey man, thanks for having me.
Yeah, well, this is usually why before the show I'm like, oh, let's go through everything on name pronunciation, and then this week I risked it, and here I tripped over a super simple one. But either way, Ken, you want to give everybody a quick background of who you are, where you're from, and what your investment model is?
Yeah. So I grew up in Toledo, Ohio. Probably never have a clue where that is. It's Northeast Ohio. Got my undergrad at the University of Toledo. Moved to Cleveland, where I became a commercial lender, spent 5 years as a commercial lender at what is now part of PNC, and went to school at night at Case Western Reserve University, got my master's there so I could then become a CPA. Spent 7 years at Deloitte doing all kinds of stuff, federal tax, state and local tax, a little bit of real estate, and a ton of M&A and due diligence. And it was there that I realized that I want to be in the corporate world. I didn't want to work 80 hours a week and miss my entire family growing up. It just made me sick to think about that. So I just started on this process of trying to figure out multifamily and real estate. A year and a half later, I bought, over that year and a half, I bought 3 deals in the Cleveland area, like a 28 unit, 24 unit, a 22 unit, sold them 3 years later, made $500,000. And that was all that it took for me to realize that, man, this is something I got to do, because I just made $500,000 on the side in 3 years. And so, fast forward now 25 plus years later, we do our own blind pool funds. We've raised probably $50+ million, done hundreds of millions of dollars in deals. So that's it. That's a pretty fast synopsis of my real estate life.
Yeah, I mean, that's a good kind of, 30-second spiel startup story is, hey, I bought my first 3 properties, made $500,000, and now I got seed capital to do whatever. And,
Right.
Didn't have to skip. You got to skip over the single family residential stuff and some of the smaller asset classes that I think a lot of folks start with just because, they don't know any better. Can you talk us through the first deal that you did? The first one.
Yeah.
Or one of those first deals.
Yeah.
How did you find that deal? How did you finance that deal? What are some challenges that you had? Because, listen, the end result was obviously positive, but I'm sure there was a lot of headaches and challenges, to get to that payday.
That's an understatement. Yeah. So back then, I'm going to date myself big time. So I found it in the newspaper ad, the classified section. Most of people, your listeners, won't even know what that is, but they had a classified section, multifamily, and there'd always be every week, 10, 15, 20 listings there. Called on one of them, 28 unit property, where they were asking $575,000. I mean, that was monumental. And I called on it. The guy was, as it turns out, he is now one of the biggest owners in Cleveland, just a stand-up guy, super nice guy. I kind of lucked out with my first seller. He helped me get set up with a contact of his for financing. And so he took back a note for 10%. I agreed to pay full price because I didn't know any better then, but it was all worth it because he helped me set up financing. He took a note back for 10%. And then I had at the time about $70,000 to come up with. So of course I didn't have any money, right? Because nobody has money when they start out in this business, and nobody understands that. They think because they don't have money, they can't do it. But almost every person I talk to that gets into this business doesn't have any money when they start. So I borrowed 35 grand on my home equity line. Now, just to be clear, I'm not telling your listeners to do that. I'm just telling you what I did. And then I went to my then in-laws and said, hey, I know you guys have a little bit of money. Maybe you could put the other 35 in, and maybe you would trust me that I won't screw this up. And they said, okay, you seem like a nice guy. We know where you live. We'll put in 35. So we went in 50-50 partners. And so we bought the deal. Now, that's how we got the deal done. And that was stressful. I will tell you back then, if you've ever been really, really, really stressed out, you get this tense thing in your throat. Well, I got what I felt to be a golf ball in my throat. Scared the hell out of me because I'm like, what's going on here? Am I getting cancer? Like, what's going on? And it was stress. I mean, it was just stress. Your body reacts really weird to stress. And as soon as I closed that deal, it went away and never came back, thankfully, right? Just speaks volumes about, how hard it is to do that first deal. You really got to push through a lot of things. So, think about this. I was, brand new family. My kids were just born basically. And I couldn't afford a $460,000 mortgage. If that deal didn't work, I was toast. I mean, there was no way I was going to be able to pay that back. So that's hence the stress. So I got the deal done, and there's always more to the story. If you don't mind, I'll share it because I bought this deal, and I'm like, all right. Remember, I had been a commercial lender. I'm a CPA, so right, I'm supposed to be really smart, right? Supposed to be, but I found this lady who lived on site. She was going to be my on-site person that would help, show the apartments, do some cleanup, stuff like that. Because I was working at Deloitte, I couldn't go there and do anything. And so she would send me her applications when she would get somebody who applied for an apartment. And here's stress number 2. All the applications were horrible, terrible credit, evictions. I'm like, man, what am I? I knew what bad credit looked like because I had just spent time at the bank. I'm like, what am I going to do? So somehow I ran across this lady named Karen. She was with the Shaker Heights Pro Integrative Housing Service. I mean, that's a crazy office. Is what it is. She said, Ken, I'll meet you at the property. I'll help you out. She was such a nice lady. She met with me. We walked the properties. Now, the property was built in the 1930s. And she says to me, Ken, your property has kitchens that were built in the 1930s. Like, have you ever seen a kitchen built in the 1930s? These giant porcelain sinks. And I mean, it was horrible. She says, Ken, nobody wants to live in that. You've got to fix it up. I said, Karen, I don't have any money. Like, what do you want me to do? I just spent every dime I had and $35,000 I didn't have just to buy the thing. She goes, look, I'm just telling you, you're going to have to do this and you'll be fine. I said, okay, how much? She goes, probably about $5,000. I was like, Jesus, Karen, you're killing me. I said, all right. So I borrowed $5,000. I think it was on the credit cards. I don't remember. Fixed up one unit, did the kitchen, just like she said, sanded all the hardwood floors, just like she said. So when I bought the property, I was trying to rent the units at $415. When I fixed that unit up, I rented the next unit to a Case Western Reserve grad student, like quality person, excellent credit with a, parents as co-signer for $599. That is how I figured out what value add was. I'm embarrassed to tell you, I didn't understand how you made money in real estate. I just thought you buy it, it'll go up in value and everything will be happy and you'll make money. I didn't understand that you actually have to force the value up by making more money, making more income. Well, that wonderful lady, Karen, from that crazy agency with Shaker Heights, she taught me that lesson. And that's how I figured out what value add was. I did that, and I did that the next property and the next property, and we do it still today. I mean, that's value add. I learned it kind of the hard way.
All right, so I got a few questions here. So was the property in Shaker Heights? We kind of know the area through some friends and family.
Oh, good.
Was your property in Shaker Heights?
Well, here's the weird thing about parts of Shaker Heights. there's a street called Southmoreland Boulevard. It is in the city of Cleveland, but in the Shaker Heights school system. That's why Shaker Heights wanted to keep up, they wanted to protect their school system. So it was weird. So it was not in the city of Shaker Heights, but that's why Shaker Heights was involved, because of the school system. So I got the benefit of paying Cleveland City school tax and Shaker school tax.
Oh, nice. All right. Well, I think area obviously helps it, right? You're in a transitional area. Maybe you're dating yourself. Guys can do some math on what rent was, when you decided to buy this based on the fact that you used a newspaper and everything else. But
yeah,
what did you? I mean, you're an accountant, right? You're a numbers guy, presumably. How much more sophisticated from like, all right, I'm going to buy this. And then here, this lady's like, well, you got to force the appreciation. And today you'd say, no shit. Like, obviously that's what I got to do. But back then you're probably going, oh, well, and luckily you factored it in, right? And you made $500,000 on your first 3 deals. Congratulations. But how much more is that calculated today? Do you have a return metric on it? I was doing quick math. You got an extra $150 a month. You're getting 1,800 on 4,500. So 33% return. Like, is that how you look at that today? Like, bring it to relevancy today.
Yeah. So now we raise money. So back then I didn't raise money. First 10 deals, we didn't raise money from outside investors. So now we obviously use outside investors. So we have very low fees, like 1% across the board fees. And our split is 80-20. So they get their money back and then we split 80-20. Well, I tell you that model because I know with that model, if I can get in the deal at close to even leverage, meaning the cap rate is pretty close to the debt interest rate, and I have $200 to $300 in upside, I know that the math will always work out that I should be able to get our investors mid-teens annual return on investment. I should be able to get about a 6% cash on cash. And I should be able to get you, if you give me $100,000, I should be able to give you back $170,000 to $190,000 in 5 years.
Yeah. I mean,
I've done the math a million times, and that's how it's kind of broken down. So that's how we now evaluate.
Keep it simple, right? Like, that's the thing. You need to be able to understand not only what you're doing as an investment, but if you are raising capital from other people, what their expectations are. Sometimes I'm jealous of Jason's model. It's pretty simple what he's paying his investors, and it's pretty direct and obvious. They pay, they make money, and it goes from there. So, yeah, man, that's absolutely awesome. What are you seeing? Obviously we talked about your first few deals. I know you're very limited on time, so we appreciate you even coming on. Like, let's skip to today. What are you seeing today? Like, what? Yeah.
The world looks totally different today. First of all, I actually understand the world a little better than I did back then.
Which is not always a good thing, right?
It is. And so that first deal was in Cleveland. About 15 years ago, we decided, man, we made money in Cleveland. What if we went to an area where people really wanted to be, where they really wanted to live? And that's why we stopped doing deals in Cleveland. There's nothing wrong with Cleveland. It's just not growing. Florida is. And so that we started that process now. That's where we are now. We're in Florida. Demand. So remember, over 27 years, you learn a lot of lessons. So now we want demand to exceed supply, right? We want the number of people that need housing to exceed the amount of housing. That makes sense. We want to be in a good, diverse employment environment. That just makes sense. See, all these little things that a listener might not think matters. After 27 years and you see what happens over that time, these things all totally matter. So now we're looking at, our deals range anywhere from 10 million to 40 million. Typically, we generally raise money and, we put in our own money. 3 to 5% is our own money, and the rest of it's from outside capital. And, now we still do a value add concept, but what we've been able to do recently, now let's talk about today, where interest rates are, where cap rates are. We're the last couple of deals we pulled down, we were able to get brand new product, literally right out of lease up, at almost a 6 cap, which in a growing market like Florida, that's just insane. That shouldn't happen, right? Because now, we've got our big boy and big girl pants on now. We raise money in advance. We come to the market as a strong buyer with money in the bank. And sellers that are selling right now, they need to close. They don't want to screw around with somebody who maybe can't raise the money. So that's what's getting us the deals that we're able to get now.
Well, so I know your plan is it's a 5-year plan on all these deals. Are you selling these things in 5 years? Or are you recapitalizing it by refinancing it?
Yeah, so it depends. It depends. So the older stuff, we don't. This is a lesson that we just learned. You got to be careful with the age of your product. If the older it
Yep.
is, the less long you want to hold it. It's probably not accurate, grammatically correct, but you want to have a shorter.
No judgment zone.
Yeah. And the newer the stuff, the longer you can hold it because you don't get yourself in trouble with major repairs. So it just depends on the asset, right? If it's a 70s, 80s build, I'm not going to want to hold it too long. If it's a somewhere in the 2000s up to, 2023, 2024, I'm cool with that. I mean, we've got one deal in Winter Haven. We've had it for 8 years. We raised 2.2 to get it, to get it done. We've returned that full $2.2 million to all the investors, returned another $1.8 million. The thing, we've just put new roofs on it out of cash flow. We've got $500,000 in the bank to update the property because the inside, it's just going to get a little dated after 24 years. And they still have $5 million in equity. Like who would want to sell that? You wouldn't, right?
Got it.
So we're holding that. Now investors have no money in it. They've almost gotten a double, and it just keeps paying them. So that's a good place to be in. If we can do that with newer assets, I mean that's how you really build massive wealth, because all that money now went and got reinvested in another asset, and it's doing the same thing. We just keep rinsing and repeating this process.
Yeah. And the rationale between the older assets is because you'll have recurring capital expenditures again, right?
Yeah,
and
that's
compared
right.
to some of the newer assets, and
That's
all
right.
of a sudden that is just going to eat up too much of the equity or cash flow, and there's no point to, you can get into a newer, better asset at that point.
That's right. Yeah, it's just hard to operate older stuff. Remember, we self-manage, so we're vertically integrated, and that helps us. But that also gives us visibility that a non-operator might not have, and it's just hard when what happens to older buildings is things inside the walls, things under the ground, they go bad. I mean, they're not meant to last forever, and so you have to fix those, and those things tend to be really expensive.
So. Yeah, I would agree with all those statements because, but I like fixing shit, and that's part of my problem, right? And it does eat up cash flow, and it does hurt. And I think a lot of people, when they look at single family real estate, they're like, "Oh, my water heater went. Who cares?" And it's like, well, no, your water heater went. Like, you just blew your cash flow for the whole year, especially if you're not savvy enough, right? So I think you make a really, really good point. And like I said, I know we have some limited time, so I want to change the subject one more time because presumably you have a lot of experience just hearing you talk, knowing on some dates that you're mentioning here. I think you were in the market pre-2008, if I had to guess.
Oh, yeah.
Okay.
Went through that.
Yep. So you went through that. Let's talk about some of your experiences through 2008 and how it's related to the most recent COVID times and what you see here in the future. Because during my open, I was going to bring up tariffs, but I was like, in the effort of time, we're not going to do that. But
yeah,
what did you see then? What are you feeling today? Is it reminiscent? Yeah. Where do you think we're, I'm interested in your opinion on that.
Yeah. 2008, 2009 was for a whole lot of reasons. But what happened to the multifamily world is debt became impossible to get. Right, because the regulators went into the banks and said all real estate is toxic. You must get rid of it. I don't care how good the customer is, and they literally made make banks foreclose on perfectly good properties just because the maturity date came up the wrong time. So, the biggest lesson I learned from that is you got to manage your debt. You got to give yourself extra room. If you think you got a 3-year business plan, don't put 3-year debt in place. Put 5-year debt or 7-year debt. Right? You'd rather be forced to hold longer than you wanted to than to be in a situation where you want to refi and you can't. So debt management is really, really, really important. And most people don't understand that, right? You would think, well, I'm not going to, if I have a 3-year business plan, why would I put 7-year debt on it? That doesn't even make sense. And I can see that. But if you've gone through 2008, 2009, it's dangerous. So this is my experience in multifamily. If the market turns against you, you just need to not lose that property and wait it out, because I'm a risk averse guy. That's why I like multifamily. People need a place to live. I can't see that going away. And if it does, money is the last thing you're going to be worried about if nobody needs a place to live, right? Because that means they're not here. So it's going to come back. You just got to give it time and don't lose your property. That's the key. So don't over leverage your property. Don't get too aggressive with your debt. That is the number. There's a lot of other stuff in 08, 09 that I learned. I mean, when you go through that process, you learn how to run really, really tight. You learn how to be really, really lean. You learn how to rent. We were back in Cleveland then. You learn how to rent in a market where the only way to get a tenant is to steal the guy next door's tenant, right? I mean, it teaches you a lot. So, the most important thing about, I mean, there's so many things that's happened in the world in the last 27 years. Now we're faced with tariffs. We had COVID. We have interest rates go from, SOFR went from 0.5% to 5.5%. I mean, those are crazy events. And so what's important, right, is this experience. That's what it all comes down to: being conservative, managing your risk, and knowing how to execute on that business plan. We have people in trouble right now who had that 3-year business plan. Maybe they did or didn't plan their debt properly, or maybe they did or didn't execute on their business plan. You see, all these things become so critical. And that's why some people are in distress now, because they didn't execute their business plan, or they didn't, expect, a 500 basis point increase in interest rates.
The expect was the hard part, because I see it on the lending side with a lot of our borrowers that are very big real estate investors, but they've only been very big for a short period of time. And it's like, you don't even know what you don't know yet. And I was like, you moved too fast. And listen, you could do a bad deal that works out great. And unfortunately, you're not learning from that. And then you do that exact same deal because, like, hey, it worked last time. It's going to work again this time. And that's not a business model. And in all fairness, some people like that's hard to learn, right? If you haven't seen it before, right? Because it's like, this is the way I've always done things and everything works. But like, we're in a changing environment and you got to stress test these things a dozen different ways.
Yeah, you're right. People, I mean, I would say for probably the last 10 years prior to 2021, 2022, I mean, if you had a heartbeat, you're probably going to be able to make money in real estate.
Yep.
Now it's different, right? Now you got to really, really nail it. So, I mean, it's probably true in any business, right? This is a business that just happens to be apartments.
Let me, and I know we got to wrap up here in a second. No
worries.
One additional question: where do you think we're at in the market? Do you think we're on the low end of the market? Do you think there's time? This is a good time for real estate investors. We can just concentrate on multiple.
To buy.
Yeah. Do you think it's a really good opportunity to buy?
Oh yeah.
Do you think folks that have rode the appreciation because they've had these things in their portfolio for years, that they should kind of sell and recapitalize into the next asset?
I think they should wait a little bit longer, just because where cap rates are. I mean, I told you, I think that I have our 2 most recent deals. We've bought at almost a 6 cap, and they're brand new deals. Like, that shouldn't be happening. You shouldn't be able to do that. So if you have, and that's what's happening. My Arbor's deal in Winter Haven, it's going great. There's no way I will sell that right now. There's none. I mean, you forget about the fact that everybody's got their money back and all that. It's interest rates are too high. Cap rates are too high. I believe they're going to come back down. I don't know when, but I think they will. And so, no, I don't think people should be selling right now. I think you should be buying. And what we see, most people, if you get any decrease in interest rates, the sellers will come out. They just will, because they're waiting for that, right? It's a lot of pent up. A lot of people want to return capital to investors, and we're not the only ones having that problem. Private equity firms are having that problem. Everybody's having it. I call it, these high interest rates kind of locked up the whole system, right? Because everybody was fully invested, and in order to invest new money, well, you got to liquidate the old and then use it to recycle it into new deals, but they can't sell. You see how the system is locked up? It's starting to unlock right now. It's starting to, because for 2 reasons. One, you guys are lenders. So, I mean, you can only kick the can down the road with a good borrower for so long, and then you gotta move, because you just have to. So that's happening a lot. And what's the other thing? People are just their debt's just maturing, and they just can't continue to extend that debt. That's the biggest reason. Or maybe they didn't execute on their business plans. So that's the stuff that's for sale right now.
Well, and the stuff that where people didn't execute their business plans, it's also hard to get the pro forma deals across the finish line, right? Like that's the whole conundrum in this thing, because then the lenders aren't as aggressive. People don't want to raise as much equity, even though equity presumably is, depending what you're paying on a pref, could be equal to the cost of some of the debt that some of these guys are getting, right? Like you mentioned, SOFR's through the roof, right? Like there's a lot of things going on. So I'm interested to see what happens. I'm deep in the conspiracy game. You know, people are saying all kinds of stuff going on in the world, but I guess if the market continues to crash, people are going to go to bonds. If they go to bonds, then rates are supposed to come down, but then there's still this money supply issue. Then again, if any of us could figure it out, we'd all be on the beach every single day having the same conversation, right? So I don't know.
What I will tell you is people need a place to live, right?
That's right.
They just do. I don't see that going away. And when we have the volatility that we've had in the stock market, that drives people out of the market because they just don't have the stomach for it. They just don't like roller coasters. And so that drives people to more stable, assets like real estate. I mean, it's just happened for the last quarter century. And people love real estate for that. I mean, most wealthy people are in real estate. Wealthy people are not stupid. Look at what they do and do it because they might know something.
Yep. That's a very stoic way to look at it. And it's a great way to wrap up this episode. Ken, what we like to ask all of our guests, what's one book or podcast that you think everybody should go check out, read, something that's been good to you?
Yeah, there's so many. I mean, I'm constantly just trying to eat information. Probably the most impactful in my life has been the 10X rule, just because it resonates with me. I mean, nothing is ever easy. You think it's going to be easy. You think you're just going to do a little bit of work, but it's never that way. And you really have to 10X whatever you thought you were going to have to do to get it done. And I've always thought that to be true. And when I read that book, I'm like, I'm obviously not the only dummy who thinks that. And since then, I mean, that's been part of the reason we're successful.
Nice. And then, Ken, where's the best place people can find you on the internet? They want to learn more about what you guys are doing over at KRI and check out any of the deals that you're doing.
Yeah, kripartners.com. So kripartners.com. When you go to our website, you're going to see that we do education and we do passive investing. So we want to help you create wealth through real estate, whether you want us to do it for you or you want to do it, we'll do it with you. Whatever works for you, just go to kripartners.com and we'll get you hooked up.
Awesome. We'll get all that in the show notes. Ken, thanks for squeezing us in today. We appreciate it. Great conversation. And guys, you can see this is just a real dude doing real deals. If you got any value out of this, please feel free to share the show. And we'll catch you on the next one.
Thanks for tuning in to the Real Estate Reserve podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.